Hi guys, I hope you're all well and blessed. So for this video, we are going to do the tutorial questions for chapter 13, right? We're not going to do the theory questions. We are only going to do the calculation questions. Only because I feel like the theory questions are easy. You guys, you can do them on your own. But then I am going to do a video where we are going to do them. But for now, I just want to do the calculation questions, right? Okay, so please get your calculator out, your pen, your book, and your pencil, your eraser, and yeah, let's get into it. So we're gonna start with question one until question four, I think. So question one, let's read the questions. They're saying that calculates the net domestic product at market price. Right, so why are we starting these questions? Okay, net domestic product at market price. So what is net domestic product? So you have to remember. Okay, let me just give you an example. So has anyone ever seen like a pay slip, like your mother's pay slip or your sister's pay slip? Like, a pay slip basically when you look at it, it firstly says gross salary, and then you have your deductions, which are like your UIF, pay as you earn, medical aid, and then you'd have your net salary, right? So um so obviously the gross is your salary with is your salary, and it hasn't been touched. Like it's the total amount that you're supposed to be earning. And then the net, it's it's gross minus something, then you get the net, right? The net salary. So same thing here. You so far, you've heard of GDP, right? GDP at market price, GDP one one. So now you're hearing of net domestic products. So this is telling you that from GDP, something has been subtracted to get what? This net here, right? And that thing which was subtracted in this case is depreciation, right? So the formula for to calculate net domestic product at market price, it's basically, so you say GDP, you subtract your depreciation. I don't know why I'm writing in capital letters, and then you get what? You get net domestic product at market price, right? So now let's find our GDP and then subtract by depreciation to get this amount here that they're looking for. So we're given GDP at market prices, which is what? 45,000. And then we're also given the figure for depreciation, which is 2,250, right? So to get GDP at market prices, we're just going to say 45,000 minus 2,250. And then you punch in your calculator. What do you get? Yes, 42,750, right? So this is the net domestic product, right? If you see nets, just know from the gross, something has been subtracted to get the net. So in this case, because it's net domestic product, it means that from our GDP, from our gross domestic product, we separated depreciation to get what? To get the net domestic product at market price. And we're given the GDP at market price, which was 45,000. Then we separated depreciation here. Then we got what? 42,750, which is our net domestic product, right? And then number two, they're saying that calculate GDP at factor cost, right? So let me just rub this off. GDP at factor cost. So remember from, if you watch the previous video that I made in J, like I think a few days back, I explained that from, okay, so we firstly have GDP, you firstly have GDP at what? At factor cost, right? Which is basically at factor, right? Which is basically the production of goods and services still what's in the factory, right? That's how I like to explain it. Then obviously you're going to add what? You're going to add taxes. You're going to add taxes on production. Ish, guys, I don't like writing on capital letters. Let me change this. I'm gonna add taxes on production, and then you will subtract your what? Your subsidies in production, right? And why do we like add let me so why do we like add taxes on production and subtract subsidies on production? Remember, I said this is the production of goods and services like still in the factory, right? Because it's factor cost. So they still in the factory. So obviously, because they're still in the factory, they're still in the production process, right? So they're going to add what taxes on production because the producers they are charged tax on their products, right? On their production, minus subsidies on production because sometimes the government can subsidize their production, right? So that is why we said it was okay, plus taxes on production minus subsidies on production. And then you're gonna get what? You're gonna get GDP. You're gonna get GDP at basic price, right? You're gonna get GDP at basic price, right? Then from GDP at basic prices, you're going to do what? You're gonna add taxes on product minus subsidies on product, right? And then you would get GDP at market, sorry, at market price. Okay, so you see, okay, so now from here, from GDP, so from the factor, from the factory, from GDP at factor cost from the factory, you add taxes on production, you minus subsidies on production, right? Because it's still in the production process. Then these products, they go away to the shop, right? Then from the shop, when they reach the shop, they're at basic price, right? Because this price, they haven't added anything from this price, right? It's just a basic price. Then from the basic price, they add taxes on products. Now it taxes on product because these are the product there in the shops, right? They're no longer in the production process, right? It's no longer taxes on production, but now it taxes on product, right? So from basic price, you add taxes on product, you subtract subsidies on product. If these products are being subsidized, right? Then you're gonna get what? GDP at market price, right? And this is the price now that me and you, when we go to the shop, this is the price that we are going to what to pay, right? When you buy these products, right? And the price that we're going to pay, obviously, it is inclusive of what? Of tax, right? Which can be like VAT. You understand? So now here they ask us to calculate GDP at factor cost. So they want this GDP here, right? Which is exclusive of tax on production, but inclusive of subsidies on production. And it's also exclusive of taxes on products, but is inclusive of subsidies on product, right? Because remember here we given what's GDP at market prices, which is 45,000. So to get the GDP at factor cost, we need to go up, right? We need to go up to be given this one. So to get this one, we need to go up. And you can see here, we can do it two ways. If we're not giving GDP, if we're giving GDP at market prices, we're going to add subsidies on products, subtract taxes on products, add subsidies on production, subtract taxes on production, and get GDP at factor cost, right? And also, if we're given GDP at basic prices, we're just going to add subsidies on production and subtract taxes on production to get this amount, right? Because if you want this one, then you do what? You add and subtract, then get this one. So now if you want now this one, it means now you're going to do what? You're going to add the subsidies and minus the taxes to get GDP at factor cost, right? And you can see now from the figures that we've been given here, we're given the subsidies. They're not telling us whether it's subsidies on production or subsidies on products, right? And also we're given the VAT, right? This is like our tax. And also we're not told duty is the one on production or it's the one on product. But we know that since we are given GDP at market price, to go up to get the GDP at factor cost, we just need the subsidies on product or the subsidies on production, and we are going to add them because when we are going down, we subtracted the subsidies on production as well as the subsidies on products, right? Can you see when we are going down to get the GDP at market prices from GDP at factor cost, we subtracted the subsidies on production, we also subtracted the subsidies on product, right? So now to go up from the market price, we need to add them, right? Also for the tax, you can see now when we're going down to get GDP at market price, we added the taxes on production, we also added the taxes on products, right? So now to go back, because now we want the factor cost, we can just say minus the tax on production and also minus the tax on minus the tax on products and also minus the tax on production, right? So taxes are being subtracted in this case and the subsidies are being added, right? So here we just given the subsidies, they're not told, they didn't tell us if it's subsidies on production or on products. But because now the subsidies on production as well as the ones on product, whether they were on production or if it was subsidies on product, we're still going to do what? We're still going to add them if we're going back, like to find the GDP at factor cost, right? We're still going to add them. So we're going to add this one, right? And then tax, for tax, we're going to subtract tax because now we are moving from GDP at market price to GDP at factor cost, right? Because we added the taxes when we are going down to get GDP at market price. Now because we're going up, we're going to do it to separate the tax, right? So this one is just VAT. So they didn't tell us if it's the one on the production or if it's the one on the product. But because like even if it was production or product, it was still going to be separated. So we're going to separate this figure as well, right? I hope you guys are getting that one. So this one is what? It's 2000. And this one is what? Okay, 2000 as well. So we're going to take the amount for GDP at market price, which is what? 45,000. So we're going to say 45, 1, 2, 3, minus 2000 for what? For, excuse me. Okay, let me just start by plus. Let me just say plus 2000 for the subsidies because they were subtracted when we were going down. So we're going to add them now. Then we're going to subtract 2000 for the what? The tax. Then what do we get? So please punch in your calculator. I'm getting 45,000, right? So this is the answer, right? You can see this is the figure for subsidies. This is the figure for what? For taxes, right? Yeah, we're given GDP at market price. So now to go back up to get GDP at factor cost, because when we were going down, we said plus taxes on production. We added our taxes on production. We also added our taxes on products, right? Then we got GDP at market price. So now to go up, it means our taxes, we're going to subtract them, right? So we subtracted that here. And then for subsidies, when we we're going down, we subtracted the subsidies on production as well as the subsidies on product. So now to go up from the GDP at market price, which we were given, which is 45,000, we are going to add our subsidies, right? Then we're going to get the GDP at factor cost, which is what? 45,000, right? You have to know this one, right? If you know this one, like from GDP at factor cost to GDP at market price, it becomes easy if now you're asked to like calculate GDP at factor cost and maybe you're given basic prices or you're given market prices, right? It becomes easy. So you don't have to know like all those formulas in that slide. You just have to know this one and then be able to work down and also work upwards, right? And then number 3, they're saying calculate gross national products at market price. Okay, let me remove this. Gross national product at market price. So gross national product is also, it can be gross national product, or it's the same thing with gross national income, right? It's the same thing. It used interchangeably, and the formula is the same, right? This one is used to calculate basically the income within within South Africa, right? So in no, not okay, no, not necessarily within South Africa, but it's income earned by the permanent residents of South Africa, right? So we exclude all the incomes that are earned by people who are in South Africa but are not like the citizens of South Africa, right? For example, we include income earned by the foreigners, right, who are in South Africa, right? So to calculate gross national product or gross national income, we're basically looking only at the income earned by our citizens, right? Anyone who's not South African, their income is subtracted from the gross national income. So we're going to say GDP minus, so we say GDP minus the income which is earned, I'm going to use Y for income which is earned by SA citizens. We're going to know minus income which is earned by foreigners in SA. So we subtract that income, right? And then we add the Y for income, which is earned by SA citizen in the rest of the world. Right. So we subtract the income which is earned by foreigners, this FO is for foreigners in SA, plus income earned by South African citizens in the rest of the world, right? That is gross national product or gross national income. So our GDP, we're given our GDP at market prices, which was 45,000, right? So now we need now to subtract the income which is earned by foreigners in SA, and then add the income which is earned by SA, South African citizens in the rest of the world. Okay. So we're going to say, let me just, we're going to say 45,000 for GDP, this one, minus income earned by foreigners in SA. So appearance money earned by Bafana Bafana in Japan. Okay, you can see that this one is income earned by SA citizens in the rest of the world, right? Because Bafana Bafana is it's a South African soccer team, right? And they earn this income way in Japan. So this 1.5, we're going to add it, right? And then wages of migrant workers from Kenya. So these are migrant workers who are here in SA, but they are permanently from where? From Kenya. So this 4,500 is going to be what? Subtracted, right? So now let's calculate. It's going to be 45,000 for GDP at market price. Then you're going to subtract the income which is earned by the foreigners in SA, which is, it is what? 1,500 plus the income which was earned by Bafana Bafana in Japan, right? And Bafana Bafana is oh no, it is vice versa. So this one was 4,500 because you can see here wages of migrants working in Kenya, working from Kenya, wages of migrants workers from Kenya. So these are our workers from Kenya but who are here, right? So we're gonna minus this 4,500. Then we're gonna add that one, okay, which is 1.5 because it's Bafana Bafana. It's the money they earned way in Japan, right? Then you're gonna get 1,500. right? I'm getting 1,500. So do you guys get this one? So G, gross national product or gross national income, we basically want to calculate income earned by South African citizens, right? Everyone, G, who's a South African citizen, whether they are here or whether they are working outside South Africa, right? So we say GDP minus income which is earned in South Africa, but it's earned by who? By foreigners. We subtract that income. And then we add the one which is earned by South Africans in the rest of the world. Then we got what? 1,500, right? So we're done with question one. It was not that difficult. So we calculated net domestic product at market prices, and then I said net. Remember, net, it means that something has been subtracted from gross, right? Because we first have our gross, then we have deductions, then we have net, right? Remember the pay slip. Your mother your mother gets the net salary because after obviously in her pay slip it's written gross salary, then they subtract her medical aid, pay as you earn, UIF, and then she end up getting what? The net salary, right? So net is after deductions. So whenever you see net, just remember there was gross and something was subtracted to get the net. So in this case, the net domestic product, for net domestic product, you say gross domestic product, which is our GDP, and it was 45,000. Then we subtracted something to get the net, which, what did we subtract? We subtracted what? Depreciation, right? That's 2,250, and we got 42,750, which is our net domestic product, right? Then also calculated GDP at factor cost. GDP at factor cost, I said, remember, GDP at factor cost, this is when the the goods are still within the factory, right, within the production process. And then because we are given the GDP at market prices here, to go up, to go down, to get GDP at market prices, we say GDP at factor cost, right? We add taxes on production, we add subsidies on production, we get GDP at basic price, right? Then from GDP at basic prices, we add tax on products, we separate subsidies on products, we get GDP at market price. So to go up, it means that we're going to go from GDP at market prices, we're going to add subsidies, and we're going to minus the taxes, right? And here we're given the subsidies, which were 2,000. So we added 2,000 from 45,000, which is our GDP at market price, plus 2,000, which is our subsidies. Then we subtracted VAT because this is like a tax, obviously. Then we subtracted this 2,000, which is VAT. 2,000 we subtracted it, then we added the 2,000, the other one for subsidies, then we got what did we get? That figure. And then also calculating GNP at market price. I said gross national product is the same as gross national income, right? We basically want to calculate the income which is earned by the permanent residents of South Africa, right? The citizens of South Africa, whether they're working here or whether they're working outside South Africa, right? So we said we're going to take our GDP, and then from the GDP, we're going to subtract the income which is earned by foreigners working in South Africa. And then we're going to add the income which is earned by South Africans that are working in the rest of the world, right? To get our GNP, and we got 1,500, right? Now let's go to question 2. So question 2, definitely gonna need a highlighter for this one. Okay, so they're saying here, Jonah is getting married soon. Jonah's brother paid 20,000 to his best friend, right? Let me do this. Okay, Jonah's brother paid 20,000 rand to his best friend, right? Koisi, to organize the bachelors. Excuse me. Koisi buys supplies from Namakwa liquor stores worth 12,000. He also hires Poach Beauty therapists to help with the serving of the beverage and pays them 2,000. Namaqua Liquor Store pays its supplier Metro 6,000 for the goods. Namaqua Liquor Store must also pay interest of 5,000 on its outstanding balance and a rent of 1,500. The wage bill for Namaqua Liquor Store is 3,200. Metro pays Metro pays 3,500 wages and 900 rental for premises. Metro also pays 700 rand interest on an outstanding loan. Right. And the question is saying, by making use of the information provided, calculate GDP using a table format according to the production method as well as the income method. Right. So we're going to start by using the production method. I don't have much space here, but I'll try to use the space in J. Nice. Okay, so using the production method, you have to remember I'm gonna try to draw my table here. So maybe something like this. And then on this side, we record this the sale value of sale. So we're gonna record the value of sales, and then on this side we record the value which is added. The value added, right? Remember from the example we did in class, right, guys? So in using the production method, now we need to read the scenario and find out to see when did they buy or sell goods, right? Obviously, that I will go under production method. And then anything that has to do with the remuneration for the factors of production, that will go under the income method, right? Remuneration for the factor of productions are like your interest, your rent. Remember, the factor of production are land, labor, interest, land, labor, capital, and entrepreneurship, right? And you know that land earns rent, capital earns interest, labor earns wages, and what else? Entrepreneurship earns profits, right? All of that will go under the income method. Production method, we're just gonna be dealing with the sales, which is basically selling, and the purchasing, which is the buying of goods, right? So let's read here. So they say here, Jonah paid his brother 20,000 rand. Sorry, Jonah's brother paid 20,000 rand to his best friend to organize the bachelors. And then Kosi buys. So Kosi buys, issue, why is it like this? Okay. Kosi buys supplies from Namaqua Liquor for worth 12,000, right? Is this amount will go where under the production method or the income method? They're saying Kosi buys. Okay, you got it right, under the production method. He also hires Posh beauty therapists to help with the serving of beverage and pays them 2,000. Right? He hires these people and pays them 2,000. Obviously, now this payment to these people is what is an income. It's like paying wages or salaries. So this one is will go with income method or production method. Yeah, you got it right. This amount is going underway, the income method. Namaqua Liquor Stores pays its supplier Metro 6,000 for the goods. So Namaqua pays its supplier, right? So is this amount gonna go under the production method or income method? Remember, Namaqua Liquor Store. This is a store, right? This is like ShopRite paying its suppliers. So obviously they're paying their suppliers because they bought these products, right? So these were the purchases, right? So obviously this is going way under the production method, right? Because why then would you pay your supplier unless you are buying goods and services, like unless you're buying trading stock, right? So this one here, Namakwa Liquor paid its supplier, which is Metro, for 6,000. They're even telling us for goods. So this was the sale of goods. I mean, this was the purchase of goods, right? And then Namakwa Liquor store must also pay interest of 5,000. Oh, sorry, 500. So interest is telling us this is what the remuneration of the factor of production, which is capital, right? So this is the income method. On the outstanding balance and rent is also the remuneration of one of the factors of production, which is land, right? So this is also the income method. Going under the income method, the wage bill, wage nje, also the income method. Wage bill for Namakwa Liquor Store is 3,200. Metro pays 3,500 for wages. This is also the income method, and 900 rental. Metro also pays 700 for interest. Also, this one is going under the income method. Right. So now we've identified the figures which are going to be recorded under the production method and those which are going to be recorded under the income method. Right. So now let's record gay for the production method. So you can see here the ones highlighted in blue, right? Those are the figures which are going to the production method. They say here, Kosi buys supplies from Namakwa Liquor Store worth 12,000 Rand, right? And then they said here, Namakwa Liquor Store pays its supplier Metro 600 for the goods, right? So what happens here is that Namakwa's Liquor Store is like, let's say Namakwa Liquor Store is like ShopRite, right? From like at ShopRite, they buy their goods and services from their supplier, which is Metro, right? For, in this example, it's Metro. They buy their goods and they buy their like trading stock inventory, right, from Metro suppliers, right? And then from Metro suppliers, the goods they go where to ShopRite, and then from ShopRite, Koisi buys these goods were from ShopRite. So we can't start by recording 12,000 because that is not where the sale began, right? The sale started when the goods first left the factory, which was it was from Metro to where to Namakwa, which is the shop, right? So you have to start recording from when the goods left the factory to the shop, then from the shop Namakwa to the consumer, right? To us, right? Like when you like for example, when you go to ShopRite to buy products, they start from the supplier first, right? Then ShopRite buys them from the supplier, right? Then we come and buy them from ShopRite, right? That is why you're gonna start with this figure here to calculate. You must also remember when you're calculating um using the production method, we basically looking we're adding the value which has been added in each stage of production, right? In each stage of production. So this is stage one, where the goods they leave what? They leave the factory to the store. And then from the store, they go to the what? From the store, okay, it's the factory to ShopRite, then from ShopRite to Koisi, who's a consumer, right? Me and you, right? Ish, hope you guys are getting that one. So here at the beginning, the value of sale is 600 Rand because Namakwa Liquor Store pays its supplier Metro 600 for the goods, right? So the value of sale that Metro receives is 6,000, right? And the value added is also going to be about 6,000, right? If you remember the example you did in class, it was exactly like this one. So the value of sale is 6,123. Okay, I want to use a different color. Okay, let me just continue with this one. 6,123. So the value added is also 6,123 as well. 6,000, right? This is the value that the value of sale for Metro. Let me just write Metro here. I'm gonna write M for Metro. So M receives 6,000 from Namakwa Liquor, right? For selling these goods, right? And the value which is added is also what? 6,000, right? Then Namakwa, gonna write in here for Namakwa. Then Namakwa receives these goods and sells them to the customer, which is Koisi, right? For how much? For 12,000. Obviously, Namakwa wants to make a profit. Like, right, he can't sell these products at the same price that he bought them from the supplier, right? He has to add a markup. So he sold them to the customer for what? For 12,000. 1, 2, 3, right? And the value which was added by N Namakwa is 12,000 minus 6,000, right? Which is what? Which is 6,000. So the value which was added by Namakwa is 6,000, right? And then also we have to remember now that Jonah's brother paid 20,000 to his best friend to organize the bachelors. So this is the amount of money that they they had to use in order to do what? To organize this bachelor, right? So we're going to record this 20,000 here as well. So 20,000 minus 12,000, you're gonna get what? Gonna get 8,000. 1, 2, 3. So the value added, if you add all of this together, you get what? The initial amount that the initial amount that Kosi was given in order to do what? To organize the bachelor, right? To organize the bachelors for his brother, for Jonah. Eh? Yeah, but you guys do get the calculations, right? How we calculated and got to this figure, right? So we started from here where the products actually where the goods were actually leaving the factory, which is by the supplier. So they were bought um from the supplier by Namakwa, and he paid 6,000, right? This is how I recorded the 6,000 here. And then Namakwa liquor store, it's a shop, like it's like ShopRite there. Obviously, they can't sell their products at the same amount that they bought them for. They have to add a markup so that they can make a profit, right? So when they sell these products to this customer, Koisi, he paid 12,000, right? So if you say 12,000 minus 6,000, the value which they added, which Namakwa Liquor Store added, is 6,000 on these products. The initial amount that Jonah's brother paid 20,000 to his best friend Kosi to organize. So the initial amount that Kosi was given by his brother to organize the bachelors is 20,000, right? So if you say this 20,000 minus 12,000, you get 8,000. So to calculate the value added, you basically just add them all together and then you get the initial amount that Kosi was given, right? And then also when you're doing this using the income method, you should get the same answer. So I'm just going to try to do it here so that you guys can see. So let's just do it here. So remember now, they say that we should use the table format. So we're going to look at the incomes that we have, right? Remember in the income method, when you're calculating the income method, we firstly add the income earned by all the factors of production, right? Which is rent, interest, wages, and profits, right? And then we add other income such as proprietors income, indirect taxes, what else? We subtract depreciation, we add statistical discrepancies and so on, right? But now you can see here that the only incomes that we have is just interest, one. We also have rent, two. We also have wages, three. And here we don't have profit, but we can calculate profits, right? So we just only have the incomes for the factors of production. So in our table, we're just going to have how many columns? 4 columns, right? For these incomes. And then maybe the last column here for the totals, right? So let's create a table with 4 columns. Just gonna write with my free hand. So it's gonna be one, many columns? 1, 2, 3, 4, right? Okay, and this one give for the totals. So in our columns, I'm just gonna write the first letter of the first word. So here we're going to have interest. So I for interest, we can just write INT. Then here we're going to have rent. Just write RNT. Okay, no. Okay. I'll just write R for rent or RE. So it's RE for rent. Then here we have wages, WA for wages. Then here we're going to record our profit, PR for profits. Right. Okay. So this is rent, RE. Also want to write it in capital letters. So it's RE for rent. Okay. So, and then now we're going to, because already we've highlighted all the figures which are going under which the income method, we're just going to record them. The only figures that would have to calculate for is the profit, right? But firstly, let's just record these amount again here. So let's just read. They're saying here, um, to organize the bachelors. Okay, let me just read from the beginning. Jonah is getting married soon. Jonah's brother paid 20,000 to his best friend Kosi to organize a bachelor's. Kosi buys supplies from Namagwa liquor store worth 12,000 rand. He also hires Pouch Beauty therapist to help with the serving of the beverages and pays 2,000. Right. So Kosi pays how much? He pays them 2,000, the ones, the beauty therapist, to help with the serving of beverages. So let's just come up with the column for. So here I'm gonna write the names of the people here. So we have K first for Kosi. So Kosi pays what? He pays wages. These are like wages, right? Because like he he hires these people, right? Obviously, if you have hired people, you need to pay them. So this is like a wage. So this 2,000 is a wage which is paid by who? By Kosi, right? K for cost. So I'm gonna record here. That's 2,000. I hope it fits. It doesn't fit. This 2,000. Yeah, it's by Kosi. And then continue to say Namaka Liquor Store pays its suppliers Metro 6,000 for the goods. Namaka Liquor Store also pays interest of 5,000. Okay, so now we have Namaka and they pay what? Interest of 5,000. So we have interest here. Then we're going to record. It's 500. Sorry, guys, 500. And then on its outstanding balance and a rent of 1,500. So rent here is 1,500. And then the wage bill for Namakwa liquor store is 3,200. So the wages is 3,200 ish. Let me try to move this one. So it's 1,500. And so from here, 1,500, and then the wages are what? Wages 3,200. Okay. And then they go on to say that Metro pays 3,000 wages, and okay, then also have Metro. They're saying that Metro pays 3,500 wages. So the wages are here. It's 3,500. 3,500. And then wages and 900 rental. So the rent is what? 900. And then for rental. And then for rental for the premises. Metro also pays 700 interest on the outstanding loan. Then the interest is what? 700. 700. Okay. So now we have all the remuneration of the factor of production, right? The only thing that we don't have is the profit, right? And how do we calculate the profit? Right. So to calculate the profit, we say, I'm just gonna write here. I'm gonna say PR is equal to calculate profit, you say the value added VA minus all the remuneration for the factor of production, right? So minus interest, INT, minus rent, RE, minus WA for wages, right? So to get the profit, we're gonna say the value added, we minus the interest, we minus the rent, and we might also minus the wages, right? To get what the profit. You have to remember now that you see here, okay, let me use this. You see here, guys, we calculated the value added at each stage of production, right? So let's just come here. So, okay, let me just make an example. Let's say I'm gonna write my own figures here with a different color, right? Let me just write with black. Let's say this is in the production, right? So I I I'm a producer, right? I'm selling these products and I'm gonna sell them for what? Let me say I'm gonna sell them for 20 rand, right? I'm gonna sell them to you. Let's say you are a seller, you have your own shop. Maybe let's say your shop is Econ 122 Traders, right? So mean a producer, I sell you these goods for 20 rand, right? I sell them to you, Econ 122 Traders. So you pay me 20 rand for these goods, right? So the value that is added, the value at that point is just 20 rand. The value that I get, me as a producer for selling these products, is just 20 rand. Then I sell them to you for 20 rand. Then you, when you get to your shop at Econ 122 Traders, you sell these products to your customers. You sell them for how much? You sell them for, let me just say 45 rand, right? Like you add a markup. Obviously, you want to make a profit. You can't sell them at the same price that you bought them from me, right? So you sell this product for 45 rand. So the value that you have added is 45 minus 20. It's going to be what? It's going to be 25, right? And then maybe that consumer, let's say we're selling pens here. So the pens left my factory to you. You bought them for 20 rand. Then when you got to your shop, you sold them for 45 rand. You sold them to this consumer who's a student, right? And then this person, she gets to class, she sees this other learner who doesn't have a pen and decides to sell this pen. It's a special pen, right? She decided to sell to her at 50 rand, right? Let's say she's going to sell it at 50 rand, right? So the value that this learner has added by this customer, who's also a learner, has added has by selling this pen to this other learner is actually how much is 5 rand, right? This is like a profit basically that you make for selling this particular item, right? So now you can see that if you add all the value added, it's going to give you 50 rand, obviously. So you can see now that for for the shop person, for you, Econ 122 Traders, you made a profit of how much? Of 25 rand for because you bought these pens for 20 rand, but you were able to sell them for 45 rand. So you made a profit of what? Of 25 rand, right? So this is not necessarily a profit as per se, because from this amount that you made, you still have to pay rent expense. Because let's say maybe you are renting that shop, right? It doesn't belong to you. So you have to pay rent expense. You also have to pay wages for your workers. You also have to pay interest on loan and all these other things, right? So from this value added that we have calculated here, 6,000 banbanbani, we still now have to separate the interest, the rent, and the wages, because to get the actual profit that you would have after you've paid for these other expenses, right? Do you guys get it? Did my example make sense? I hope so. Okay, let me just remove these figures again. So now we are just going to calculate the profit that each person made from buying and selling these products, right? So for okay, no, this is K. So for K, the profit that K so the profit that K made, how are we gonna okay, so oh, it's supposed to have K here because this is the amount which was given to remember this initial amount it was given. They said here Jonah's brother paid 20,000 to his best friend Kosi to organize the bachelor. So this is the initial amount that Kosi was given, right? So the value which is added by Kosi at this stage it's 8,000. So to get the profit, we're going to say, remember we said value added minus this is value added minus the interest, minus the rent, minus the wages, right? So because he did not pay any interest or any rent, they are only the wages because he also hired these people here, right? The Poach Beauty Therapist, right? To serve beverages. So you're gonna say 8,000 minus 2,000, right? And you're going to get, so I'm gonna use a different color for this one. So you're going to get what? You're gonna get 6,000. This is a profit, right? That K made. So it's gonna be 1 and 6,000, right? Is it 6,000? 8 minus 2, yeah, it's 6. And then we move on. So within N for who? For Namakwa Lekwa. So we go to Namakwa. Namakwa, this is the value which value added by Namakwa is 6,000, right? So we're gonna say 6,000 value added minus 5,000, which is the interest that is going to pay, minus the rent, which is 1,500, minus 3,200 for wages, and then we're going to be left with his profit, right? The profit that he actually made, which is how much? I'm just trying to confirm the figures because I did this thing. So it's Namakwa. It's 800, 2,800. Can I just confirm this one by calculating it because I'm not sure as well. So we're saying that six. I'm sorry, guys. Can we say 6,000? 1, 2, 3 minus 500 for interest, minus 1,500 for rent, minus 3,200 for the wages, and then you get yeah, it's actually 800. So it's 800. So this is the profit that Namakwa made. And then for Metro suppliers, we're going to say also 6,000. We're going to say 6,000, this one over here, minus 700, minus 900, minus 3,500. And then you're going to get 900, right? So now to calculate the income, because we are asked to calculate GDP using the income method. So now to get the income, we are basically going now to add all the remuneration for the factors of production to get this income over here, right? So we're going to say 2,000 plus 6,000, which is what? 8,000, 8, 1, 1, 2, 3. And then 5,000 plus 1,500 plus 3,200 plus 800, which is what? 6,000. And then also here, I'm gonna say 700 plus 900 plus 3,500 plus 900, which is 6,000. And then if you add this, all of this, you add 8,000 plus 6,000 plus 6,000, you're gonna get what? 20,000, right? So now you can see that the figure for, so using the production method and using the income method, we got the same amount. Therefore, we did a great job. Our answers might be correct, right? So guys, did you see how we did it, okay? Basically, what we did here, we firstly calculated for the using the production method, right? And we got the value which was added at each stage of production, right? Then our GDP using the production method, we got to it was what? It was 20,000, right? Then now we had also to calculate using the income method. And because here, the only incomes that we have with the remunerations for the factors of production, right? Which are what? Interest, rent, and wages. And then also we calculated for the what? For the profit. Because we know that now to calculate profit, you say the value added minus interest, minus rent, minus wages, right? You get your profit, right? And then now after calculating our profit, we added all our remuneration for the factors of production. Then we got our what? Our GDP using what? The income method, right? So now let's do the next question. Mm, okay. The next one is saying that use the following information to calculate GDP according to the production, income, and expenditure methods. Show in each instance where you get your numbers from. Excuse me. A jeweler Jacob in German sells 30 grams of jewelry pieces at 50 rand per gram to Lovisa in France. Jacob pays 50 rand wages, 200 rand, and 350 interest on loan. Lovisa refines the jewels and creates earrings, where they sell 30 packs of 1 gram earrings to Glamour J at 200 rand per gram. Lovisa pays 330 on wages, 600 rand for refining and manual machinery, and 900 rand interest. J sells 30-gram jewels and makes a profit of 2,500, but also pays 1,200 salaries, 800 rand, and 500 interest on their business bank account. The GDP, according to the income, spending, and production method, will be so it's easier here because the table was given. So basically, we just need to fill in this table, right? We have Jacob, we have Lovisa, we have J. So we are told here at the beginning that a jeweler Jacob in German sells. Okay, so you can see from our table, this side we're gonna use it to calculate using the GDP using the what the production method because here's our value added, like VA for value added. Then on this side we're gonna calculate it using what's the income method, right? So the answer we get from this side should be the same as the answer that we're gonna get from this side, right? So they're saying that here. Okay, so firstly we draw a table and then they're saying a jeweler Jacob in German sells 30 grams of jewelry pieces at 50 rand per gram to Lovisa in France. So you can see because now they're talking about here selling and purchasing. Obviously, this is going with in the production method, right? He sells. So it's Jacob who sells 30 grams of jewelry at what? At 50 rand per gram to who? To Lovisa in France. And then they continue to say Jacob pays 50 rand wages. So now you see now these are wages. So where are they going? Where sorry, these amounts we're gonna use them when we calculating GDP using which method? Yes, the income method. So 50 rand wages, 200 rand for rent, because these are the remunerations for the factor of production, right? And 350 for interest of loan on loan. And then Lovisa refines the jewels. So Lovisa first buys the jewels from Jacob in German, right? Then he refines the jewel, meaning that this product that he purchases here from German is not the final product that he's going to sell. He firstly has to do something to it, which is to refine the jewels and then create what? Earrings, right? Where they sell 30 packs for 1 gram earring to Glamour J at 200 rand per gram. So Lovisa is like now another. So this was like they purchased these product from, I'm gonna say this is a factory, and then Lovisa is a store. But before they sell this product, they first refine them and then they sell them to Glamour, who's a customer, at two 200 rand per gram, right? So okay, no, Glamour is not a customer because he also sells them and makes a profit. So Glamour also has his own store. So let's just say this is a supplier. Jacob just supplies jewelry pieces, right? And then Lovisa buys these jewelry pieces from Jacob's and then refines them to make earrings. Then sells these earrings to Glamour, who has a shop, right? And I'm gonna say Jay, guys. And Jay has a shop, and then in his shop now he's selling these finished products, which are earrings, right? And making a profit of this amount. Okay, let's just continue reading again. They said here, Lovisa refines the jewels and creates earrings where they sell for 30, 30. So he sells 30 packs. I wanted to use the same color as that one. Where is it? So it's this one. He sells 30 packs of one earring to, he sells them to this one, to J, yeah. So I'm sorry about that. So um Lovisa will sell 30 packs of one earring to to Jay at what? At 200 per gram. Right. Then Lovisa pay. So now also Lovisa, because he also has his own like production company. You see, they take these jewelry pieces, they refine them into earrings, and then he sells them to Jay, this business, at 200 rand, right? And then Lovisa also has its own people, like within the shop, that he has to pay them what? To pay them their wages. So he pays wages of 330 and also pays 600 for the rent. He's also renting the space. He doesn't own it. And then for refining and manual machinery, okay, for renting and so on, and also pays 900 rand for interest, right? So Lovisa is also paying these things like interest, rent, and wages, right? Which are the remuneration for the factors of production, right? And then the statement continues to say, ish, J sells 30 grams. So now J is the store, right? Remember, Jacob sold jewelry pieces to Lovisa. Then Lovisa takes these jewelry pieces, refines them into what? Into and creates what? Earrings. Right. After creating these earrings, he sells these earrings to what? To Jay. And then Jay also has his own shop. Right. So Jay is Mr. Price, right? They're selling earrings. So here's Jay. Also, Jay sells 30 grams jewels and makes a profit of 2,500. So you can see here they're not telling us Guti, how much is he selling these jewels for? Because all this time they're telling us Guti, about Jacob and Jamin sells 30 grams for 50 rand each, right? And then Lovisa also refines these jewels and sells 30 packs of 1 gram earrings at what? At 200 per gram, right? But here, when it comes to J, they're just telling us ukuthi J sells 30 grams jewels and makes a profit of 2,500. So then they're not telling us ukuthi how much is he selling these earrings for. So I think that is the amount we'll also have to calculate, right? So, but let's just highlight the profit because this is also one of the remuneration for the factor of production, which is entrepreneurship, but also pays salaries. Also, this is the remuneration, and then it the rent as well as the interest. Right. So now the ones in go there. So the ones highlighted in page, it's the figures that we're going to use to calculate the value which is added, right? And this one is just straightforward. Here at the beginning, it's basically where Lovisa buys the jewelry pieces that he uses in his production process, and then sells the earrings to Jay. Then Jay sells to the customer and makes a profit of 2,500. So we're gonna say for Jacob, the value of sale is 30 times 50, right? Because he sells these products for 50 rand, 30 grams for 50 rand. He sells them to Lovisa. So the amount that Jacob is going to receive from Lovisa is what? Is 30 times 50, right? So if you say 30 times 50, you're going to get what? 1,500. So they recorded here from Jacob 1,500, right? Because he's selling these products for 1,500. This is the amount that he's going to receive, right? And the value which is added is just going to be how much, guys? Yes, you got it right. It's just going to be 1,500, right? And then after that, okay, I want to use a different color so now you guys can see what we added here and what was already here. So let me just use blue. So that's 1,500. Okay, and then now we continue. Let's read the from Jacob. Sorry. Okay, so Jacob sells these these pieces of at 50 rand to Lovisa, right? And then Lovisa refines the jewels and then creates earrings and sells them and sells 30 packs of 1 gram earrings to Jay at 2,000, right? So Lovisa is gonna make how much here for selling these earrings? It's gonna be 200 times 30, right? So if you say 200 times 30, you're going to get how much? You're going to get 6,000, right? This is the amount that Lovisa is selling these earrings for, right? This is the amount that is going to get when he's selling this earring. Don't be confused by this one, right? This one is just the amount that Lovisa paid to Jacob, right? And then this one, like there's no significance of these amounts here. I don't know, but like I don't think they would make any impact if they even if you do include this column or if you do not include this column, because usually we have the this column and this column. Remember, we have the value of sale column and the value added column. So don't be confused by this one. But then like this 1,500 rand, it's the amount which Lovisa paid when he was purchasing these jewels, right? Remember, this is the amount that he paid to Jacob, right? This 1,500 was paid to Jacob, right? When Lovisa was selling these jewels. And then he refined them into earrings and he sold them for what? For 6,000, right? This is the 6,000, right? The value of sale. And then now to get the value added by Lovisa, you're going to say 6,000 minus 1,500, right? Then what do you get? Please punch in your calculator. So what do you get? Okay, so I'm getting 4,500, right? And then we also have Glamour J. Okay, we're just going to call him J, yes. So what does J do there? We said here, obviously, where they sell 30 packs to J at 2,500, okay, Lovisa refines the jewels and creates earrings where they sell 30 packs of earrings to J at 200 grams. Right. Lovis, okay, let's leave that one. Glamour J sells 30 jewels and makes a profit of 2,500. So you can see here, they're showing us ukuthi Glamour J is going to buy these earrings for 6,000, right? He's gonna buy these earrings for 6,000 and then he sells 30 grams jewels for how much? They don't tell us for how much, right? Because if they had told us ukuthi he sells 30 grams at 50 rand, we would just say 30 times 50, then we're gonna write that figure here, right? Gonna write that figure here. But now because they didn't tell us ukuthi he sells them for how much, we we're going to have to solve for this figure here, right? And this one as well, right? Because to get this one, you need to say this minus this to get the value which is added, right? But now we know the profit then that J made is 2,500, right? So let's record the profit. Okay, they've already recorded the profit for us, right? 2,500. And you know how to get this profit, right? I did tell you to get the profit, you say to get the profit, where am I gonna write this? Okay, can I just write here? So to get the profit, I'm gonna say PR. I said Uti, you said value added, right? Then you subtract all the remuneration for the factor of production. So you say minus wages, you minus the rent, RE, you minus the interest, NT, right? Is it that all? You minus the wages, you minus the rent, you minus the interest from the value added to get the profit, yes. So because we already have a profit, it means that, okay, we don't have the interest as well. Oh, we told you, Aguti, he makes a profit of 2,500, but also pays 1,200 salaries. So 1,200 salaries is here. We say 1,200 rand salaries, it's here, you can see. And then 800 rent, 800 rand is here also. And 500 interest, right? So let's just record the interest here, which is what? 500 rand, right? So now to get the profit, we would have said this value added here, minus this, the wages, minus this, the rent, minus this, the interest, we get what? The profit. But now we're given the profit, so how are we going to get the value added? Yeah, you got it right. Because we're subtracting when we're going this side. So now because we're going backward, we're going to do what? To add. So it's going to be 2,500 plus 5,000, sorry, plus 500 plus 800 plus 1,200 to get the value added, right? So your value added is how much? Please calculate. Yeah, it's 5,000. Is it 5,000? Yes, it's 5,000. I'm getting 5,000. So if you say 5,000 minus this, minus this, minus this, you need to get the profit. Do you get it? If you get it, then our value added is correct. So now to get the sale, the value of sale, you're just going to say, because if you are to get your value added, you would have said this amount here minus this one, you would have gotten like this one, right? So to go back, what do you say? You're going to add, right? So you're going to say this plus this, you're going to get this amount here, the value of sale, which is what? Which is 11,000, right? To confirm, just say 11,000 minus 6,000, you're going to get 5,000, right? So if you add the value added, you add all of them together, how much do you get? You will get what? 11,000. So the value added GDP using the value added or the production method, we get this amount. So even in this side, we should also get the same figure, right? So let's try now to calculate for this side here using the income method now. Did you guys get this one? Okay. I hope you guys did. So we have Jacob here. Let's just read what the amount that Jacob paid for wages and rent and so on. Okay, so yeah. We said we took him. Jacob pays 50 rand for wages, 200 rand for rent, and 350 for interest. So let's record for Jacob. 50 rand for wages, yes, and then 200 rand for rent. So we just have to record the 200 rand for rent. Yes. Yeah. So 200 rand for rent for Jacob. So he also pays 200 rand for rent, and also he pays 350 for interest. So to get the profit for Jacob, you know, to calculate profit, you say the value which is added, which is 1,500. Then you're going to subtract your wages, your rent, and your interest to get the profit, right? So, so what do you get for the profit, guys? It's 900 running 900, right? The 900, yeah. And then for okay, this one we already have all the figures, but let's just read again to see where they got them for Lovisa. Said Lovisa. So they say Lovisa refines the jewels and creates earrings where they sell 30 packs of 1 grams earrings to Jay at 2,000 grams. Lovisa pays, this is what he pays. He pays 300 rand, 330 on wages, 600 for rent, and 900 interest, right? So let's record for Lovisa is 330, 600, and 900. So to get the profit, you're going to say the value added minus wages, minus rent, minus interest to get the profit, right? Remember, guys, why we're doing this? I told you that the the value added is like, okay, remember, Lovisa bought these goods for 1,500, right? And he sold them for 6,000, right? Obviously, if you buy goods for 1,500, you can't sell them for 1,500 again. You have to sell them at a higher price so that you can also make a profit. And in that money that you are making, which is now the value which is added here, because you said what the sales that he made from selling these goods minus the cost of these goods, you get this one, 4,500, which is the value added. That so from this value which is added, you still have to like pay the laborers, right, the workers. So 3,000, sorry, 330. And then you also have to pay rent, right? 600. Also have to pay interest, 900. Then you can have what? Your profits, right? Then you can have your profit. So let's calculate, guys. 4,500 minus 330 minus 600 minus 900. What do you get? Okay, I'm getting 2,670. And then here we've already calculated for this one. So now to get the sum of income, you basically add all the incomes, right? So we're going to add the incomes for Jacob, the incomes for Lovisa, the incomes for Jay. Then we're going to add them together again. And when we add them together, have to get this amount here, right? 11,000. So let's add them together, guys. Low. So we're gonna say 50 plus 200 plus 350 plus 900. Then what do you get? Okay, I want to use a different color for this one. So let me use this. So I'm getting 1,500. 1500. And then also here we say 330 plus 600 plus 900 plus 2,670. You get what? 4,500, right? And here they calculated for us. You just say 1,200 plus 800 plus 500 plus 2,500. You get what? 5,000. So if you add all of these amounts, how much do you get? Okay, I'm gonna write the total here. Let me just add them because I also, okay, so you say 1,500. I just assume they are the same because plus 4,500 plus 5,000, I'm getting 11,000. Yeah. So 11, 1, 2, 3. So yeah, guys, we got the correct answer. The answers are the same. So we did this. We are we are good. We are very smart. So guys, we're done with this table. If you didn't understand anything, guys, just pause the video, like, or go back. Or if you didn't understand me, then like get someone who can explain it to you better. I'm sure Nje, there's someone who understands this thing better than me. Like, yeah. So let's continue. Oh, we're doing the last question. This is question 3. Going for the last one. Question 4 is that's the last one. Okay, now question 4, they're saying that Using the expenditure approach, calculate GDP. Expenditure approach is one of the easiest approach, guys. Like to remember, especially because you just say C plus I plus G plus open bracket X minus Z. Z for exports, Z for imports, X for exports, right? This is sometimes called the U. So this is sometimes called the what? The net export. So if you just find net export, just know that they've already calculated it for you. Now it's just the final figure. So they've already said X minus Z and then they got this amount. So it's net exports. The total figure when you say X minus Z is called net exports, right? So, and also with investment, right? Our lecturer was explaining this today in class to say that with investment consists of two things, right? It consists of, so if you, let's just go to the table here, right? Yeah. Can you see you have net private domestic investment? You have net, right? So remember I told you that if you have net, it basically means ukuthi something was removed, right? You have to add something to get what? To get gross domestic investment, right? Gross means ukuthi, okay, now it's like it's everything. Nothing was removed. But net, it means that something has been removed. Remember the first activity we did, how to calculate net domestic product, right? Net domestic product. And I said, ukuthi, because now it's net, it basically means ukuthi they have removed something, right? Which was the depreciation. They removed depreciation from what? From the gross. So GDP minus depreciation, you get what? Net domestic product, right? So even in this case, because now we have net private domestic investment, basically means they've removed something. That is why we have net. So to get the gross investment here, when you're calculating GDP using the expenditure method, this I here is for the gross investment, right? We're supposed to get what's the GI, like, right, the gross investment, right, which is equal to the net private investment, the one which I was showing you. Let me just go back again. This one, the net private domestic investment, which is equal to that one, plus, plus what? Plus the consumption. You can say it's consumption. No, no, I'm saying capital letter C. Okay, it's plus the consumption of fixed capital, which is sometimes called what? Depreciation. Right. So these two added together, they give you what? They give you the gross investment, right? So this I here, when you're calculating the expenditure method, is supposed to be inclusive of what? Of the net private investment as well as the consumption of fixed capital. Consumption of fixed capital is basically just the purchase of fixed capital. So when you're actually purchasing like equipment and so on, right? Purchasing those things is like investment, guys, because you're investing in your company, right? It improves the value of your company, right? So it's like investment. Sometimes you can find it as consumption of fixed capital or just consumption of fixed capital brackets depreciation, right? So you're gonna add it together to get the gross investment. But if you can see that in your timetable like this one, you can see it's okay, maybe it's not net, maybe it's gross domestic investment. Then you don't have to add like consumption of fixed capital. Maybe you see it's okay, there's a figure for consumption of fixed capital, and there's also another one for gross domestic investment. Just take gross domestic investment and put it here, right? But if you have net, then obviously you're gonna have to add something to get gross. right? Because from the net, it means something was removed. So you need to add that thing back to get the gross investment. Okay. I'm sure you guys get this one now. Look, so let's just calculate again. So we're calculating GDP using the expenditure approach, and this is the formula. It's just C plus I plus G plus X minus Z. So I'm sorry. So we are basically adding up all the sources of consumption. Is the source of consumption. But yeah, because like we're gonna add the consumption by households, the consumption by the government, and then investment, obviously, and then consumption that occurs within the foreign sector through exports and what and imports, right? Because it's expenditure, right? We just want the expenditures by everyone in the economy, right? From the household to the government. So we're going to say, I just wanna open my answers here. So I don't waste time calculating. Okay, so for C, it's consumption by household, right? C. Okay, and here, personal consumption expenditure at 613. So we're going to record, I'm going to come here, then we're going to record 613 plus, and then for I, we know for I, we have to add the net private investment plus consumption of first capital, right? So let's go up here. Base net private domestic investment, it's 83. Then consumption of first capital is 68. So if you say 83 plus 68, what do you get? 151, right? I'm getting 151. So we are going to add 151 here as the gross, obviously. 151 plus 50% one here. 151 and then plus, okay. Also have to add what? The government expenditure, because we're adding all the expenditures, right? So government expenditure, now it's government purchases, 150, no, government purchases, 180. So then a plus 180 plus exports minus import, right? Let's find the export. Okay, we don't have exports, we don't have import, but we have what? Net exports. Remember, I told you that if you say X minus Z, you get what? Net exports. So they've calculated for us. It's just 28. So you're just going to add 28. So we're going to say plus 28, then equals to, sorry. So what do you get? Please punch in your calculator, guys. I'm getting 972. All right. So this is our what? Our GDP using the what? The expenditure approach. And then they say verify your computation of GDP above by using the income approach. So remember I said when using the income approach, you firstly add all the remunerations of the effects of production, right? The four of them, which is the interest, which is the interest. Let's go up there to see, which is the interest. Here's the interest, here's the rent, there's the profit. Okay, we have proprietors income. But you're gonna add firstly all the remunerations of the effects of production, and then you're going to add indirect taxes, gonna add statistical discrepancies, you're gonna add proprietors income, gonna add depreciation. Depreciation we added in the income method, depreciation is added, right? And then the expenditure approach, it is added together with the what? Net private investment, right? To give you gross investment, right? So or aggregate investment is the same thing. So what was I saying? So we're gonna add all the incomes earned by the effects of production, all the remunerations for the effects of production, and then we're gonna add indirect taxes, we're gonna add depreciation, we're gonna add statistical discrepancies, and actually there is a formula here. Yeah, you want to add interest, profit, plus depreciation, indirect taxes, and then we're going to subtract net foreign income earned, and then we're going to add statistical discrepancies, right? We subtract net foreign income earned or subtract subsidies, right? If there's net foreign income earned and also subsidies, we subtract them both, right? So let's go back. You see here, the expenditure approach, they say IG. This IG, it stands for what? Aggregate investment, right? Meaning the total investment. So it's another way of expressing this GI here. They can put it like this, so don't be confused. Okay, so now we're calculating using the expenditure method, right? So we're just gonna add the wages, proprietors income, and all of this. Okay, so let's start from the top. Let's start from the top. I'm just gonna highlight everything that we have to add. Is that fine? I hope it's fine. I'm not gonna write it down. Okay, let me just remove this one first. As you guys saw how we calculate using the expenditure method, right? So now so for the the income method, you're going to say all the incomes. Okay, personal consumption, this is expenditure, rent, this is the income. There's gonna be 35, interest, 33, proprietors income, compensation of employees, these are wages, statistical discrepancies, indirect taxes, corporate profit, this is a profit. Okay, and then you just go up, up, up. Goes in. Because I just have to remove all of this. Okay, but you guys saw what you highlighted. So it was what? It was rent, interest, proprietors income, compensation of employees, which is like a wage, statistical discrepancies, indirect taxes, indirect business tax, corporate profit, I mean. And then we're going to separate net foreign factor income earned. We separate this one. We also separate the subsidies, right? Oh, I forgot. We're also going to add the depreciation. Remember, we add the depreciation in the income method. Then you add all of this, and then I think you're going to get the same answer. You have to get the same answer. So it's going to be 972, right? Then it's going to be 972. Are we done? No. But hence compute net domestic product. Okay, now we have to compute net. Remember, guys, when you see net, what do you think of? Net. You think of the pay slip, right? When you get your pay slip, you would have something like gross. It's written like this, guys. So you have something like this. It's like gross salary. Then they have deductions, right? And then they put all your deductions, UIF, ban, your F, and then you're going to have what? The net salary, right? Let me just put the deductions on brackets, right? Right, so from gross, something is subtracted to get what? The net. So here you can see they're asking us to calculate what? The net domestic product, meaning that from the GDP, which is the gross domestic product, right? Something was subtracted, right? Which is what? Depreciation. To get what? To get the what? The net domestic product, right? So we calculated the GDP right here and here. We got 27. Okay, no, we got 972, right? Is it 972? Yeah, 972. And we're gonna minus the depreciation. So our depreciation is what? Here's our depreciation at 68. So we're gonna minus 68. Minus what? Minus 68 equals to 904. Yeah, and you guys can look at the formulas. Yeah, we have the formulas done here. Not net domestic product, it's GDP minus depreciation. and so on. Yeah, guys, that brings us to the end of this video. I hope you guys learned something from this video. Yeah. I'll see you guys in another one. Bye. Good luck.